There's been a lot of chatter on a potential US stock market recession after what happened over the last week, and so I think it's only timely for me to give you a summary of what's happening right now, a quick update on some of the leading economic indicators and what you can expect in the very near future as an investor. So it all started on the 1st of August when US Fed Chairman Jerome Powell announced that they are not cutting in the interest rate and leaving it at a range of 5.25 to 5.5%, the same level since July last year. He also hinted that a rate cut on the upcoming September meeting is on the table, but it's most probably not gonna be a 50 basis point rate cut. And the market received it pretty well initially, but not until the US BLS released the July jobs report a few days later, which reported an unemployment rate of 4.3%, an increase of 0.2% from June's 4.1%. Non-farm payroll grew by 114,000 in the month, which was way below the analysts' expected baseline minimum of around 180 to 200,000 jobs, even after accounting for a recent surge in immigration. In a nutshell, less of their locals are getting jobs, while more of them are actually getting laid off. And this immediately caused concerns on whether the Feds are actually too late when it comes to lowering the interest rate. So much so that based on the Fed Rate Monitor tool right now, as of the recording of this video, the market is almost pricing in a 100% possibility of a 50 bips rate cut on the 18th September meeting. And if you notice from the list of job gains and losses, information or technology was actually down the most at 20,000, which continued to raise the question whether the AI bubble has popped already or not, and the market is growingly concerned about it. And of course, the whole ordeal was made worse when you pair it with a lot of earnings misses and also sales slowdown. Like for example, Amazon reported an earnings miss and also providing a pessimistic guidance for the upcoming quarter. Intel reporting an income loss of $1.6 billion in Q2 and planning to lay off 15% of their employees. Nvidia reportedly delaying their upcoming Blackwell AI chip for at least 3 months, which might have industry-wide impact. Major automakers like Ford, Stellantis, which is behind Chrysler, Nissan and also Tesla had also experienced sales slowdown and missed their earnings by quite a margin. Basically, Americans are simply not interested in getting a new car loan amidst the high interest rate environment, on top of the prospect of potentially losing their current job. And if you also look at the luxury watch market, which by its nature a rich man's hobby that should not be bothered so much by the broader economy, they also lost a significant amount of steam over the last 12 months across major brands like Rolex, Patek Philippe, Audemars Piguet and so many more. I mean, if you can see here, even the richer demographics are also pulling back on their spendings. And it also doesn't help when renowned investor Warren Buffett, or Berkshire Hathaway to be specific here, trimmed 50% of its stake in Apple and held a record amount of cash at $277 billion, which have increased tremendously because just 3 months earlier in the previous quarter, they were also holding a record of $189 billion. Some economists interpreted this move as being very defensive, while some said it is a common trimming exercise since it's one of Berkshire's largest holding. I mean, to each of their own. There are also external factors like the Bank of Japan increasing their interest rates from 0 to 0.1% to now around 0.25%, the highest they have been since 2008, on top of a reduction of their bond buyback program, basically removing liquidity out of their economy, and their stock market index immediately crashed more than 12% overnight, its biggest one-day drop since 1987, for which I quote Goldman Sachs analysts, investors don't believe the Japanese economy can take a 25 or 50 bips policy rate hike, and that they don't think Japanese corporates can make any money with the yen below 150 against the US dollar. And over in the UK, the Bank of England, on the other hand, have just recently cut their interest rates by 25 bips, a move many speculate to be earlier than expected, or a sign that the UK economy simply cannot withstand the high interest rate environment any more longer. Hence the rate cut. Now, I believe that should give you a very good picture of what's happening in the market right now. But as an investor, it's also important for us to analyze the macroeconomic indicators before we jump into any conclusion. There's a few that I've always been following, but let's start with the simplest and the current market sentiment via the VIX, aka the fear index, where 15-ish is usually considered as the average range. Needless to say, it has shot up to a very high level of over 30 as of the recording of this video on the 6th of August. In fact, it hit over 65 just one day ago, so you know how everyone's feeling right now in the market. The 10 to 2-year yield spread, commonly known as one of the most reliable recession indicator whenever it's inverted, or negative in this case, was deeply inverted or negative for the last 2 years since July 2022. It is now currently closing into 0%. Historically, this indicator usually turns positive before a downturn begins, with the short-term treasury yields dropping faster than the longer ones, mainly because the market is pricing in an emergency rate cut or a huge one to save the weakening economy. Yikes. Now, if you look at the Purchasing Managers Index, short for PMI, aka a leading indicator whether businesses are optimistic or pessimistic about the economy outlook. Usually 50 being the neutral range, anything above 50 is optimistic, while anything below 50 is pessimistic. As of the latest report, the manufacturing PMI stood at 46.8% on an overall downtrend for 4 consecutive months, while the services PMI stood at a slightly healthier level of 51.4%. This shows that consumers are probably spending less on buying styles, but instead more on experiences and also traveling. And you would think that investors are fleeing the market already. I mean, some yes, but according to the FINRA margin debt level, which measures the amount of margin or debt that people are borrowing from stockbrokers to invest in stocks, basically more margin means more risk on mode. As at June, it still stood at a rather high level of 1-year high and almost as high as before the Fed decided to increase interest rate back in early 2022. This shows that the market is still at risk on mode, at least as of June, which is about 2 months ago. But of course, we'll need the latest data at least for July and August to tell a better story. So, what's my 2 cents worth of opinion? Are we entering a recession, or is this whole thing overblown? Well, to quickly answer that, I would lean to a slight yes, as the whole thing is slightly overblown to me, since that's how media always like you to harp on the negatives. Plus, the US CPI inflation has sort of cooled down to the 3% mark for quite a bit. I know it's not 2%, but this could very well be the new level that the Fed needs to settle on, considering the massive amount of M2 money supply that is still currently circulating, at least in the US economy, and is showing no sign of slowing down at all. But having said that, the economy slowdown is real. People are spending less on goods like cars and even luxury hobbies like watches, and coupled with a slowdown in job growth, continued layoffs in tech, and the ever so competitive nature of all things artificial intelligence AI, which means more R&D costs before any meaningful profits roll in. The stories are pretty in line for a slowing economy, or at least a slump in the tech industry in my opinion. And I do see the merit of how much damage a high interest rate environment can do to the broad economy. So I suppose it's not so much of whether there will be a recession or not, but more so whether you are prepared for a recession or not. With the US general elections on the horizon and potentially a jumbo interest rate cut in the upcoming 18th September, it's really hard for any of us mere mortals to predict what's going to happen, especially with such a chaotic situation right now that they are in after the Trump incident. My point is, recession is not a 1-week thing. The market will never move in a straight line or even be predictable. So we are bound to see lots of rebounds and then dips and ups and downs. I mean, the volatility is part and parcel of a dynamic market. So as long as you got yourself covered properly, at least 3 to 6 months worth of expenses in liquid savings for emergencies, coupled with some credit facilities ready by your side, and probably not committing too much to any huge life expenses, at least not until the upcoming election is over, I say continue dollar cost averaging even through the market corrections, and potentially shop for quality assets with a strong balance sheet and non-gimmicky business model when opportunities arise. I mean, it's not rocket science. It's all about managing your emotions to be a contrarian when the market tells you otherwise. Let me know what you think about the stock market. I hope you found this update helpful, and if you like more videos like this, consider hitting the like and subscribe button down below for more. And do check out the links down below, as you will also help out the channel for free. Thank you and have a great day ahead.